Something shifted this week that most financial channels are either screaming about at the top of their lungs or completely getting wrong. There is a real event unfolding in the Middle East right now. Oil crossed a number that most Americans have not seen in years. The internet is absolutely flooded with predictions about silver and gold going to levels that sound almost unbelievable. Some of those predictions are grounded. Some of them are pure panic dressed up as analysis. If you do not know how to tell the difference, you are going to make an expensive mistake. Before you move a single dollar, before you buy or sell anything, stay right here for the next few minutes. What I am about to walk you through could genuinely change how you see this market situation. Not just today, but for the rest of this year. If this kind of breakdown is useful to you, and I have a feeling it will be, go ahead and subscribe to Element Axis right now. We cut through the noise on precious metals, energy, and macro investing, so you do not have to spend your whole day untangling headlines. Hit that subscribe button and let's get into this together. Now, let's start with the thing that almost nobody is leading with, even though it should be the very first line of every conversation about this situation. The Strait of Hormuz. If that phrase does not immediately register for you, here is why it needs to. That narrow stretch of water sitting between Iran and Oman is not just an important shipping lane. It handles roughly 1/5 of the world's entire petroleum liquid demand. 1/5, an even larger portion of oil that moves by sea passes right through it. When military or political tension puts pressure on that corridor, markets do not sit back and wait for confirmation. They reprice immediately. Oil gets adjusted, freight rates get adjusted, marine insurance gets adjusted. All of that happens before most people have even finished reading the headline. This past Monday, crude oil crossed back above $100 a barrel. If you have been watching markets for a while, you know that number is not just a price. It is a psychological line. Every time oil crosses that threshold, a whole sequence of events gets triggered. Inflation fears do not ease. They come roaring back. The moment inflation fears return, the entire question of what the Federal Reserve is going to do with interest rates gets reopened in a way that makes everyone deeply uncomfortable. Higher energy prices mean stickier inflation. Stickier inflation means those rate cuts everyone was hoping for get pushed further and further down the calendar. This chain reaction is the real story, not just the war itself, not just which country is involved, not just whether a specific city is open or closed. The real story is what elevated oil prices do to the economic machinery that every American is already living inside of. When gas gets expensive, the cost of moving food gets expensive. The cost of manufacturing gets expensive. The cost of running a business with thin margins becomes suffocating. Consumers, especially Americans in that 45 to 55 plus age group who have already watched their purchasing power take a serious hit over recent years, start pulling back. They stop reaching for growth and start looking for shelter. That shift in collective behavior is what the market calls risk-off. I want to be precise about what that phrase actually means in practice because it is being thrown around way too casually right now. Risk-off does not mean every investor calmly sells their stocks and walks into gold like stepping into a warm room. It almost never works that cleanly. What really happens is uglier and faster. A fund that is already down in one position gets a margin call and has to sell whatever it can sell quickly. A trader who thought they had the energy setup figured out suddenly finds themselves overexposed and cuts their entire book to reduce risk. An everyday investor who felt fine a week ago looks at their portfolio and starts trimming things they actually believe in because the uncertainty got too loud to ignore. That is why you can get a situation where oil is rising, inflation fears are rising, geopolitical risk is rising, and yet gold and silver do not just go straight up. If everything is scary, why would you not rush into safe havens? The answer is that when the whole system is under stress, people do not always sell what they hate. They sell what they can. That includes metals. Not because they think gold and silver are bad investments, but because gold and silver are liquid. When you need to raise cash fast, meet a margin call, or reduce exposure across the board, liquid assets are the first thing you reach for. This is a point that deserves a real pause. A lot of people watching this have worked hard for what they have. You have been building savings, building retirement accounts, maybe adding some physical precious metals along the way. When you hear that conflict is escalating and oil is above $100, your instinct is to assume metals must be going up, and that is the safe trade. That instinct is not wrong in the longer picture, but the shorter picture can be brutal. If you're not prepared for that volatility, if you're not expecting turbulence before the thesis plays out, you might panic and sell at exactly the wrong moment. Let me be direct about the difference between the long-run case and the short-run reality. This is the part most channels completely skip over. The long-run case for gold remains genuinely strong. Central banks around the world have been adding to their gold reserves consistently, not in a panic, not because of this specific conflict, but as a slow, deliberate, strategic decision to hold more gold as a reserve asset. That kind of buying is not emotional. It does not react to Monday morning headlines. It is institutional, patient, And it creates a floor underneath the gold market that does not evaporate when traders get nervous for a week. That floor matters. Even when gold experiences short-term selling pressure from forced liquidations or dollar strength, there is sustained demand underneath it from some of the most sophisticated holders of capital on the planet. That is not nothing. That is a structural support. Silver's long-run story is different but equally compelling. Silver has been in a supply deficit, not just this year. Multiple consecutive years of more silver being consumed than being produced. The demand side is being driven by both investment interest and a massive industrial story. Solar panels, electric vehicles, advanced electronics, defense applications, medical technology. Silver is not just a shiny coin you put in a safe. It is a critical industrial input that modern infrastructure literally cannot function without. When the market is already consuming more than it produces year after year, any additional stress on the physical supply chain does not just add a little pressure. It compounds pressure that already existed. You absolutely have to understand that silver is emotionally violent. That is not a criticism. It is simply its character. Gold attracts institutional money, pension funds, central banks, long-term wealth preservation capital. Silver attracts all of that, but it also attracts a very different crowd. It attracts traders who want explosive upside in a short amount of time. People who hear a war narrative and position aggressively for a breakout. When those two completely different groups are both crowded into the same market and something unexpected happens, silver can move in ways that feel almost irrational, extraordinary in the morning, genuinely painful by the afternoon. That is not a glitch. That is silver doing exactly what silver does. If you have held silver through one of those brutal short-term reversals, drop a comment below. I am genuinely curious how many people watching this have experienced that firsthand. Because if you have, you know exactly what I mean. And if you have not yet, consider this your warning. Now let's talk about Dubai. There has been a flood of content this week making claims about Dubai that range from slightly exaggerated to completely detached from what the evidence actually shows. And this matters for precious metals more than most people realize. Dubai is a genuinely important hub for global gold trading. Its share of global gold trade runs into the mid-teens percentage-wise. That is not a trivial number. That is a significant portion of the physical gold that moves around the world passing through one city. So when there is disruption in that region, the question of how gold physically moves, gets stored, gets insured, and gets settled between buyers and sellers becomes a real practical concern. But here is where I want to push back on the most dramatic framing going around. The claim being repeated is that Dubai has essentially gone dark. Everything is shut down. Flights are grounded. The gold market has ceased to function. And when I look at what is actually verifiable, that picture does not hold up cleanly. There were absolutely real disruptions. Airspace restrictions, delays, heightened caution from insurers and shippers. That part is real. But flight activity as recently as Monday still showed meaningful operations. Not normal, not perfect, but far from the total shutdown the most extreme voices are describing. Why does this distinction matter to your wallet? Because if you're making financial decisions based on worst-case assumptions that turn out to be exaggerated, you will overreact. You might buy aggressively into a spike built on misinformation. Or panic sell at a bottom because you thought the situation was more catastrophic than it actually was. Precision is not just an intellectual exercise. It is how you avoid expensive mistakes with real money. The more accurate picture is this. Dubai's trading environment is strained. There is friction. There are higher costs. Settlement cycles are stretching. Insurers are cautious. Buyers and sellers are taking longer. That kind of operational stress can ripple outward and affect the broader physical market in ways that extend far beyond one city. But a strained market and a broken market are two completely different things. Markets can stay strained, expensive, and frustrating for a very long time before anything resembling a true structural break appears. Go ahead and share this video with someone you know who is trying to navigate precious metals right now, because this is exactly the kind of context most people are not getting, from channels that just want to keep them glued to the screen with fear. Here is another layer that most analysis is missing. The psychology of how retail investors actually behave when geopolitical fear combines with rising energy prices and a wall of social media noise. People imagine some kind of clean, coordinated movement where the smart money smoothly exits risky assets and flows into safety. That story is satisfying, almost cinematic. But here's what actually happens. The fund manager who was overweight in tech and got hit by rising energy costs needs to raise cash fast. He is not calmly reallocating into gold. He is selling what moves. A trader who used margin to build a leveraged silver position wakes up to a gap down and closes that position at a loss before things get worse. An investor in their late 40s, who had been gradually building a commodity position, sees their account flash red and makes an emotional decision to cut everything just to make the anxiety stop. These are the forces that create chaos in precious metals during the exact moments when logic says they should be rising. This is precisely why the investors who survive these periods intact are almost never the most aggressive or the most certain. They are the most boring. They held physical metal without leverage. They did not try to trade the headlines. They understood that their time frame was years, not weeks. When silver dropped hard because a hedge fund needed liquidity, they did not panic. They either bought more or they sat still. That kind of patience is genuinely rare and genuinely valuable. Now, let me address the stagflation scenario directly, because this is what makes the next several months particularly complicated. If oil stays elevated and does not come back down meaningfully, you get a specific and unpleasant combination of conditions. Slowing growth on one side because energy is expensive, businesses are tightening, and consumers are spending more on gas and less on everything else, and sticky inflation on the other side because energy feeds into every other price in the economy. That combination is stagflation. And stagflation is the central banker's nightmare because their normal tools stop working cleanly. If growth is slowing, they want to cut rates to stimulate the economy. But if inflation is still running hot from energy, cutting rates risks making it worse. They are stuck, unable to move decisively in either direction without creating a new problem. That paralysis keeps financial markets in a state of prolonged uncertainty. And prolonged uncertainty is very uncomfortable for everyone. In that environment, the dollar can stay stronger for longer than expected. When the world is uncertain, capital tends to flow toward dollar-denominated assets as a default. A strong dollar is a headwind for gold and silver because metals are priced in dollars. When the dollar rises, metals become more expensive for foreign buyers, which reduces global demand and puts downward pressure on price. This is one of the cross-currents that makes navigating metals in a geopolitical environment much harder than the simple headline of fear equals metals up. That said, none of this is an argument against owning gold or silver. The stagflation scenario, if it fully plays out, is ultimately supportive of precious metals over a longer horizon. When governments cannot control inflation, when real interest rates are deeply compressed, when trust in paper assets erodes, gold and silver are historically two of the best places to be. We have seen this before. The path from here to that clear metals bull run can have painful chapters in the middle. Those chapters are what I want you to be psychologically prepared for. If this breakdown is giving you more clarity, hit the like button. It genuinely helps more people find this kind of analysis, and it tells me what content is actually useful on Element Axis. Let me now make this practical, because I know some of you are not here for theory alone. You want to know what to actually do. The first thing is to get clear on your time frame before you do anything else. If your time frame is the next 2 weeks and you are trying to trade war headlines with borrowed money or leveraged products, this environment is genuinely dangerous. Not because the long-term case for metals is wrong, but because the short-term path is violent and unpredictable enough that even being right about the direction does not protect you if you are wrong about the timing or position size. Leverage turns volatility into forced decisions. And forced decisions made under pressure almost always cost you more than the original mistake that triggered them. If your time frame is 2 to 5 years and you are building a position gradually with money you do not need in the near term, then the noise of this week is largely irrelevant to your thesis. If metals get hit hard from forced selling or dollar strength, and you have dry powder available, that may be one of the better entry points you will see in a market with structural support underneath it. The second thing is to know what you actually own. This sounds obvious, but it genuinely is not. A physical coin at home, a bar in a private vault, a gold exchange traded fund, a silver mining stock, and a futures contract are all called gold or silver in casual conversation. But they behave completely differently when the market comes under stress. A coin in your hand has no counterparty risk, but it has liquidity risk if you need to sell quickly in a local market that is not prepared to give you a fair price. An ETF is liquid, but introduces counterparty considerations. A mining stock can move 2 or 3 times the magnitude of the metal in both directions and carries operating risk, management risk, and jurisdiction risk. A futures contract can be wiped out by a margin call before the thesis has time to play out. None of these are automatically good or bad, but treating them as interchangeable because they share the same metal name is a mistake that costs real money. Third, think carefully about location risk. If you hold metal in a storage facility in a region experiencing geopolitical stress, that does not mean you are trapped, but it does mean your experience will be more dependent on local conditions than you expected. If flights are restricted, if insurers are pulling back, if shipping costs are elevated, then moving your metal in or out of that location becomes harder, slower, and more expensive. Convenience during calm is not the same thing as convenience during a shock. Thinking ahead now costs nothing. Let me address what happens if this conflict does not fade quickly. If this is a sustained period of elevated pressure rather than a short spike, everything about the investment environment changes in important ways. If the Strait of Hormuz remains under threat, even without a formal closure, the risk premium on oil does not disappear when the initial shock fades. It stays embedded. Markets price in the possibility of disruption even when disruption is not happening every single day. Freight rates and insurance costs stay elevated. Energy prices stay elevated. Inflation projections stay elevated. The rate cut so many people were counting on as a catalyst for risk assets keep getting pushed further out. Supply chains that had started recovering get hit with another round of cost increases. Countries that depend on imported energy watch their trade balances deteriorate. Corporate margins that were already thin start getting squeezed again. Equity markets that had been holding up on hopes of a soft landing start pricing in a world where that landing keeps getting delayed. In that environment, the safe haven bid for gold tends to strengthen over time, not because of one specific headline, but because the accumulated weight of uncertainty pushes more and more capital toward assets that have historically held their value when the financial system is under stress. We have already seen central banks doing this deliberately over the past 2 years. That behavior does not reverse because of one complicated week in the markets. Silver's story in a prolonged stress scenario runs on 2 tracks simultaneously. In the near term, if industrial output slows because energy is expensive, some of the industrial demand for silver softens with it. That weighs on the price. But in the medium term, the supply deficit story does not disappear. The underlying demand from clean energy infrastructure, from defense technology, from advanced electronics, from medical applications, that demand is structural and not cyclical. When liquidation pressure from leveraged investors eventually passes, that structural story reasserts itself against a backdrop of inadequate supply. Years of consumption outpacing production does not get erased by a rough week of trading. The investors who come out of this period in the strongest position will not be the ones who made the loudest calls or took the most aggressive bets. They will be the ones who kept their cost of being wrong as low as possible. Minimal leverage, position sizes that can be held without panic, instruments that match their actual time frame, a clear separation between long-term conviction and short-term recklessness. You can deeply believe in gold's long-run case and still be conservative about how you express that belief right now. You can understand silver's supply story and still acknowledge the tape is dangerous today. You can believe physical metal is the most reliable form of wealth preservation, and still recognize that jurisdiction, liquidity, access, and spread all matter in ways that no simple slogan captures. Holding all of those things in your head at the same time is harder than just picking a side, but it is dramatically more useful. So let me leave you with a framework rather than a prediction, because a framework serves you across many different market environments, while a prediction serves you for one moment and then leaves you stranded. Think about energy first. Oil is the immediate transmission mechanism of this conflict. Watch what oil does because it tells you what inflation is about to do and what the central bank is about to face. If oil stays elevated, the path for rate cuts narrows, and that has ripple effects across every asset class. Think about liquidity second. When markets move from expansion to stress, the first thing that changes is how easily assets can be bought and sold at fair prices. Wider spreads, higher insurance costs, slower settlement, more cautious counterparties. These are the signs that liquidity is contracting. In a contracting liquidity environment, leverage becomes a trap rather than a tool. Think about precious metals third, but with a genuinely split perspective. Constructive on the longer horizon because the structural case remains intact. Cautious on the shorter horizon because forced selling, dollar dynamics, and positioning risk can all create ugly moves in the near term, even in assets that are fundamentally right for the macro environment. And think about your own situation. Fourth, what is your time frame? What is your purpose? What instrument are you using? What is your position size relative to what you can actually hold through turbulence? Those 4 questions answered honestly will do more for your outcomes than any specific prediction about where silver trades in 3 weeks. The noise right now is genuinely loud. The fear is real. The stakes are real. But the path forward is not to react faster or bet bigger. It is to think more clearly, hold less leverage, respect what you do not yet know, and keep yourself in the game long enough for the bigger story to fully play out. Drop your thinking in the comments. Do you think this conflict burns hot and fades fast? Or do you think this is the beginning of a prolonged period of elevated risk that keeps oil, inflation, and precious metals front and center well into the rest of this year? I read every comment, and I genuinely want to know where your head is at. And if you know someone trying to figure out what to do with their savings right now, share this with them. Not because it gives them a buy signal or sell signal, because it gives them a framework. And in a market like this, a good framework is worth more than any single prediction. That has always been the real edge in markets. It remains the edge today. Stay sharp, stay patient, and keep watching Element Axis. This content is for informational and educational purposes only, and is not personal financial advice. Always consult with a qualified financial professional before making investment decisions.